Thank you for joining me. It is Thursday, May the 11th, 2017. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and the short term is about confidence and sentiment. This month, I'd like to cover some thoughts I have regarding what is likely to bring down this unstoppable market. Unfortunately, and I mean that sincerely, I've seen this theater once too many times over my years in the markets. I would like to cover the areas shown here as a guideline as we go through trying to understand what will bring down the market. It is becoming much more than likely that the triggering catalyst will be falling stock buybacks, igniting an inherent issue with passive investing. Growing global liquidity concerns almost make this a certainty without continued and dramatically increasing central bank liquidity injections. Here's the underpinnings of the current exposure. We have slowing buyback funding, passive investing, and failed liquidity. First of all, buybacks. The market is built on buyback financial engineering, which is slowing due to revenue, EBITDA, and leverage problems. 2. Portfolio insurance. Passive investing and its ETF instruments of destruction is acting as a modern form of portfolio insurance, which was instrumental in the historic 1987 market drawdowns. ETFs, in my opinion, will soon be seen to have been financial weapons of mass destruction. Passive investing. Passive investing has insidiously taken price discovery out of the market and forced a few stocks to dominate the index returns, not too dissimilar prior to the 2000 dot-com drawdown as a result of a few technology, what they call generals. Global liquidity. Global liquidity is slowing dramatically, and central bank policy actions are creating further stress on an already serious liquidity problem. Let me explain each of these by stepping through unfolding developments and illustrating the hidden and not well understood interdependencies. Buybacks. Buybacks have been dominating market buying for the last 4 years. No surprise there, we've covered it many times over the last at least 3 years. It has been expected to reach about $700 billion in 2017. That has changed, as I'll show you in a minute. But notice that ETF growth, right below it, is expected to contribute approximately $200 billion in 2017, according to Goldman Sachs. Between the two, we have $900 billion of purchasing power expected. However, notice below these two that all traditional areas of buying are exiting or have exited, certainly dramatically reducing their exposure. And we'll talk further about the really important reason for this. Here is an update to Goldman's buyback chart that shows that buyback expectations based on corporate announcements has significantly fallen from $700 billion to $510 billion between March the 17th and April the 27th in just over 30 days. And I think it's going to continue to fall. That is a dramatic reduction in buying power or purchasing flows. The shift is already underway. Corporate buybacks in April were the lowest in 6 years. Buybacks by corporate clients for the month of April were the lowest of any April since 2011. Trailing 12-month buybacks remain at 4-year low and are down more than 20% from last year's levels. This suggests we could see less of a boost to earnings per share from buybacks versus recent years. The S&P 500 firms have authorized $146 billion in share repurchases year to date, a 15% drop from the comparable point last year and the slowest pace since 2012. Corporations cut annual spending on buybacks by 11% in 2016, and executions year to date have plunged by 20% versus last year. We need to understand that buybacks are just a form of balance sheet leveraging or financial engineering assisted by central banks, and it's creating a leverage problem, which I'll show in a moment. Goldman is now warning in this chart, to which the bid is now plunging. It appears that the number of companies buying back their shares has also peaked, and those who have been buying are now reducing their rate because of cash flow to debt ratios, now impacting their credit ratings. Lowered credit ratings would drive up the cost of the existing debt, which needs to be rolled over. They've got to keep their credit ratings. They've got the brakes on in many cases or about to apply them soon. This is about market liquidity. The Bank of America, separate from Goldman Sachs, gave the latest confirmation that this dynamic of professional investors and institutions exiting the market is accelerating when it reported that it had just observed that the biggest institutional sales in nearly a year. Specifically, and I quote, it stated, last week, during which the S&P rallied 1.5% amid optimism on Trump's tax reform, that we think, and that is Bank of America, that may signal the end of the Trump put. Bank of America Merrill Lynch clients were net sellers of U.S. equities for the second week in the amount of nearly $3 billion. Bank of America's Jill Hell adds, and I quote, this was the largest net sale since 2 weeks prior to the Brexit vote in early June last year. She further notes that, quote, clients sold both single stocks and ETFs. It is important to note that this was the first ETF sale since mid-September 2016. Continuing her quote, net sales were led by institutional clients, whose sales were the largest of any week since mid-September 2015, and private clients were also net sellers for the first time in 7 weeks. Later she said clients sold stocks across size segments with small cap stocks, where we recently turned bearish, seeing net sales for the first time in 4 weeks. End of her quote. What did the Bank of America clients sell? Pretty much everything, obviously, with an emphasis on taking profits. Broad-based sales across all sectors except utilities, according to Bank of America. Clients were broad-based net sellers of stocks across 10 of the 11 sectors, with sales led by this year's winners, consumer discretionary and technology. Only utilities saw net buying, similar to the prior week when only utilities and telecom saw inflows. Tech continues to have the longest consecutive selling streak with net sales for the last 8 weeks, and sentiment remains the most persistently bearish within healthcare, where less volatile 4-week average flows have been negative since March of 2016. Year to date, telecom is the only sector which has cumulative inflows entirely due to private clients buying. When we look at client activity on a 4-week rolling average basis, hedge funds have been net sellers of U.S. stocks on a 4-week average since March 2017. Institutional clients have been net sellers on a 4-week average basis since early February 2016. Private clients have been net buyers of U.S. stocks on a 4-week average since late March, and corporate client buyback activity continues to suggest weaker trends than this time last year. That is down 22% year over year, and trailing 12-month buybacks are, as I said earlier, at 4-year lows. The underlying dynamics are simple. Institutional investors, whether voluntarily or because they are forced to through redemptions, are selling risk exposure to retail investors, something that J.P. Morgan, separate from the other two, Goldman Sachs and Bank of America Merrill Lynch, observed 2 months ago in a paper entitled Institutions, Hedge Funds Are Using the Rally to Sell to Retail. All of these major institutions are being quite clear and spelling this out in advance of what they're expecting here. Returning to reduced share buybacks, we need to understand why this is occurring and why it will accelerate. First of all, revenues, as we've been writing about for 2 years, have been steadily falling. As such, price to revenue ratio are at historical highs of 2.45. We've talked about this in previous months. They are quite literally off the charts. Though stock buybacks make smaller earnings look better on an earnings per share basis, it doesn't hide the reality of falling revenues for those who care to look. But falling revenues eventually lead to another problem. That is EBITDA, falling EBITDA. The problem is it reduces cash flow. But the EBITDA measurement, which stands for earnings before interest, taxes, depreciation, and amortization, shows the problem. Too high a cash flow relative to debt is considered excess leverage and obviously makes companies more risky and as a consequence their credit less sound. The trend on a year-on-year change basis of net debt to operating cash flow has been steadily deteriorating. Every good thing eventually comes to an end. If excess leverage is used to solely drive up stock prices, is that realistically considered a good thing? I don't think so. It's a good thing that market stocks are going up, but for what reason? What we see here is the distortion that this has caused in stocks between the US and the Eurozone market, for example, and other markets. It is more pronounced in the emerging markets and is a reason many larger players are focusing now more on non-US financial markets. Let me talk briefly about IBM. IBM is a classic example of the ongoing deterioration in the non-FANG and NOSH headline stocks. As you know, FANG and NOSH are one of our SII focuses. And this is about what is going on at the fundamental level that few are recognizing. Revenues at IBM have been steadily falling quarter after quarter with simply no end in sight. However, IBM has been leaders in the stock buybacks with their cash, but are now being crimped by credit downgrade concerns. Meanwhile, the share price has recently slowly started to fall and maybe even possibly accelerating. Despite being one of the most aggressive buyback monsters on the street, you can't say IBM stock price has soared recently. In 2014, in fact, the company actually eased off a bit on its buybacks and the stock then headed south. It headed south because IBM was beset by fundamental growth issues. Its revenues from old line businesses were shrinking and there was no revenue from other businesses like the Watson and artificial intelligence replacing it. The lesson here is that no amount of financial engineering like buying back shares can replace management's inability to grow the business. That's what you have to look for. And these businesses, other than in a few cases in the General's case, we'll get to that, are not growing. And in the General's case, it's a problem with profits. And this is all going to come home to roost at some point in time. The frightening offsetting factor here that I showed about ETFs is the shift to ETFs has been a major paradigm that is now only being recognized for the danger it potentially presents. We showed how dependent the markets are on ETF flows. For example, the Power Shares Buyback Achievers ETF, which symbol PKW, actually tracks market cap weighted index of companies that repurchased at least 5% of their outstanding shares in the previous 12 months. That's the level of granularity of ETFs we now have, and most are well aware of this. But in some way, they all track back to some of the major indexes and some of the major generals, and we'll get to that. But this growth in ETFs has been astounding, and it's replacing money that was in mutual funds or managed money, where decisions were made on fundamentals and various parameters on which was a good stock, which is a bad stock, versus ETFs, which are baskets of stocks. Baskets of stocks that are chosen in many ways, but often related to major indexes or major momentum players. And as you can see in this chart, of an active manager, a mutual and hedge fund such as Ocean Ziff, which recently suffered its biggest year-to-date redemptions and drop in assets under management in history. This is not untypical of the movement out of mutual funds and ETF and what goes with it, as I just described. What I believe we potentially have here is a modern form of what was once called portfolio insurance. Portfolio insurance was thought to be a method of hedging a portfolio of stocks against market risk. In that case, it was about short selling stock index futures. The technique was invented by Hayne Leland and Mark Rubenstein in 1976 and is often associated with the October 19, 1987 stock market crash. It was the villain of the 1987 market crash by using products which employed stock index futures and options to assure institutional investors that they need not worry if market prices seem to be unreasonably high. And it succeeded. Like today, there were concerns prior to the 1987 crash that the use of portfolio insurance could lead to many investors selling stocks and futures simultaneously. There were many articles citing concerns that during a declining stock market, the use of portfolio insurance could snowball into a stunning rout for stocks. This is exactly the potential we have today with ETFs, since they are being bought as effective derivative products of the underlying stocks without consideration for fundamentals and felt to be protected because they are a basket of stocks diversified, which can be liquidated in a single keystroke or stop loss. I suspect in the future many are going to understand how quickly a market can become illiquid and how problematic lock limit down markets can be during a scramble for the exits. If passive investing is fundamentally about buying diversified index-based markets, let's consider what is driving the indexes. What's driving them? Well, let's look at buyback stocks. Firms with the largest buybacks have been consistently beating the S&P 500. As a consequence, their importance to the market has become greater due to the use of market cap weightings across most of the indexes. Firms with dividend growth have outperformed buybacks since 2016 and therefore have increased their market caps. Most of the major dividend growth players have been using borrowing to fund dividends, and as a consequence, their market caps have increased on a market cap weighting basis and have become bigger contributors to the various popular ETF index and sub-indexes. With borrowing for the use of buybacks and dividends beginning to be crimped, we can surmise there is a potential problem looming. The dot-com bubble, when it finally burst in 2000, was being held up by a handful of stocks which were referred to at the time as the generals. Today, we currently have the same phenomena, but with a different set of generals. 5 companies out of the 2,500 NASDAQ stocks account for 45% of the recent gains. The same 5 companies account for 28% of the S&P 500's 2017 returns. The top 10 companies account for 46% of the S&P 500 2017 returns. We have never seen anything like this before. This is a complete and total breakdown in market breadth, and nobody's talking about it. It is worse than 1987 and worse than 2000. It is only the old guys like me that remember this is new. Services like robo-investors, which are popular with the potential 77 million new millennials probably beginning to enter the market, weren't around during these horrific events. Of course, we all know it will be different this time, but somehow I just don't think so. Just the names will be different. The big 5 are now 42%, 41.9%, and 12.5% of the market weightings in the NDX and the S&P 500, the NDX being the NASDAQ Top 100. As I mentioned earlier, the core problem with passive investing and ETFs is a structural disconnect with fundamentals, and therefore proper price discovery. The Shiller Cape shows the levels to which the distortions have been taken. The corruption to proper price discovery and fundamentals prior to the dot-com bubble imploding is illustrative, with understanding that at that time, eyeballs and page views were justification for many of the general stock price. Today, nobody even wants to use those terminology, but at one time, that's all we heard. It ended badly and abruptly when cash flow was realized to be paramount and in extreme short supply. That is what's looming here, falling cash flows. We need to initially remember that due to sustained stock buybacks, there are now a lot fewer stocks outstanding to actually buy. Apple has spent billions buying back their stocks, and this is one of the major contributors to the indexes which passive ETFs are buying. knowingly or unknowingly, without any regard to realistic valuations. It's working. Fewer stocks because of the buybacks, driving up the indexes, ETFs coming in. It just is a cascading, and it's feeding on itself. And with the shortage of stocks, stocks can only go up if they're chasing the same basket of stocks that where they have actually been reduced, as opposed to diversifying where they may not have been buying back their stocks. And so therefore there are stocks out there. The competing forces of shrinking buybacks with increasing passive investing buying a shrinking pool of available stocks will soon be resolved. Expect the sell orders to be anything but passive when prices begin falling. It will be, in my opinion, lock limit down for the market. A final point regarding how sentiment and perception quickly changes. I believe this is where we are now. We are in the delusional stage. And you know I've been talking about this for at least 18 months now. It can last a lot longer than you expect, and I think it will. I am not calling for an imminent market collapse, as negative as I've been here in some of these charts. Why I'm not as concerned that it's imminent, and I'm not saying there won't be some scary moments, but why I don't think there's an imminent collapse in the market is that the recent inflection from skepticism to optimism could be the first step towards market euphoria that we typically see at the end of a bull market, and that has been glaringly absent so far in the cycle. The sell-side indicator shown here is based on the average recommended equity allocations of Wall Street strategists as of the last business day of each month. Wall Street consensus equity allocation has been a reliable contrarian indicator, with the S&P 500 indicating dividend yield currently above 2%. That implies a 12-month price return of 14% and a 12-month value of 27.27 on the S&P 500. At that level, the forward PE would be well in the 20s. When the indicator has been this low or lower, total returns over the subsequent 12 months have been positive 95% of the time, with median 12-month returns of 22%. This suggests this most hated market, as described by many pundits, may still have more to run as cautious investors finally just simply throw in the towel rather than lose out of the investment opportunity of a lifetime. That is usually the last blow-off. We also need to understand that as long as the central banks are injecting between 200 and 250 billion per month into the global markets, it is pretty hard for markets to sell off. Additionally, as long as central banks like the Swiss central bank continue to buy 20 billion of the generals per quarter, it is effectively a floor under the market. It is also hard for markets to sell off when the central banks like the Bank of Japan are so strongly buying the equity markets. Eventually, however, this will all end badly. We may not know the timing, but at least we know now what will eventually bring down the market. And we are starting to see cracks that at any time could break wide open. Time will tell when that'll be. As I often remind you at the end of these slide presentations, remember, they will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react, and they're trapped. Your chances of success go up dramatically, but be cautious, because things can change in a heartbeat. I'd like to take this moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 be an outstanding investment for you and your family. Thank you for listening.